Welcome to Talk Tickers. Today, we're diving into what might be one of the most interesting earnings calls of the season, Dick's Sporting Goods' first report since bringing Foot Locker into the fold. And let me tell you, this was not your typical run-of-the-mill update. This was a line-in-the-sand moment, a declaration of a massive strategic overhaul. Management was incredibly direct, and we're going to break it all down. And boom, right out of the gate, Executive Chairman Ed Stack gives us the quote that perfectly sums up the entire call. We need to clean out the garage. This just set the tone for everything that followed. This isn't about a little tune-up for Foot Locker. We're talking about a full-blown, down-to-the-studs renovation. So how did the numbers actually shake out? Well, it's really a tale of two completely different companies living under one roof. On one side, you've got this absolute powerhouse, and on the other, you've got the project. I mean, just look at this contrast. It's pretty wild. The core Dick's business is just on fire, comps up 5.7%, and they're actually raising their guidance for the year. That's a huge sign of strength. But then you look over at Foot Locker, negative comps and an operating loss. This massive gap is so important because it's exactly what gives Dick's the firepower to even attempt this huge turnaround. And if you need a picture, well, here it is. This chart just lays it bare. You've got the core Dick's engine absolutely humming along, just churning out cash and stability. And that's what's going to fund this whole capital-intensive project for Foot Locker. One engine is really pulling the weight for two right now, and that strength is what gives management the guts to make these big, bold moves. Okay, so with that performance gap crystal clear, let's get to the main event, the playbook for Foot Locker. Management didn't just come to the call complaining about problems. No, they showed up with a clear, aggressive game plan to fix this fixer-upper. And again, management was just brutally honest. Stack basically said, look, Foot Locker forgot the basics. Retail 101, right? They had way too much of the stuff nobody wanted, and not nearly enough of the hot sellers, especially after their biggest brand partner decided to go all in on selling directly to consumers. This is the core problem they are now attacking head-on. So, here it is, the four-step plan. It's simple and direct. First, liquidate all that old inventory that's just collecting dust. Second, shut down the stores that aren't making money. Third, bring in a fresh leadership team, which they've already started doing. And fourth, all of this, every single move, is pointed at one target, hitting a major turning point for the business in 2026. Now, a plan this aggressive, it doesn't come cheap. You knew that was coming. Management was super clear that the fourth quarter is going to look pretty ugly for Foot Locker's financials. But, and this is the key, they're framing it as necessary medicine, short-term pain for long-term gain. And here is the price tag for cleaning out that garage. A jaw-dropping drop of 1,000 to 1,500 basis points in gross margin for Foot Locker in Q4. This number is huge. It's all about the massive, aggressive markdowns they need to do to just get rid of years of old product. They are ripping the Band-Aid off big time. This table really puts it all together for Q4. You see the core Dick's business just chugging along, solid, stable, expanding margins. And then you have Foot Locker, guided way down on comps, taking that massive margin hit and ending up with a slightly negative operating income. It's a planned investment, sacrificing one tough quarter for what they hope is a much healthier future. So why on earth would they go through all this pain? It comes down to this one word, accretive. All it means is that the acquisition will finally start adding to Dick's earnings per share instead of dragging it down. And management put a stake in the ground. They said they expect Foot Locker to be accretive by fiscal 2026. That is the finish line. That's the light at the end of this tunnel. Okay, so we've heard the results, we've seen the turnaround plan, now it's time for our take. We've chewed on all the data from the call, and now we're going to put our rating on the stock. And really, this is the million-dollar question for any investor looking at this stock right now, isn't it? Is the strength of the core business and this bold new plan for Foot Locker a golden opportunity? Or is all the risk and the short-term pain just too much to stomach? Our call is outperform. We believe management has a plan that is not only credible, but absolutely necessary. And more importantly, they have the financial strength in their core business to actually pull it off. So let's walk through why. First, you've got that fortress of a core business. It's the engine that pays for everything. Second, this clean out the garage plan isn't just talk, it's aggressive, and it tackles the real problems. Third, we think once the market gets past the ugly Q4 numbers, all eyes are going to shift to that 2026 earnings story, and that's a huge potential catalyst. And finally, and this is crucial, the big brands like Nike are totally on board with this new vision. We expect the stock to move higher as the market starts to believe in that 2026 story. On the next call, we'll be watching for any early signs that the inventory clearance is working and what the new leadership has to say. So, that's our take on Dick's Sporting Goods. It's definitely a fascinating story to watch unfold. This is not financial advice.